Well, investors are ducking for cover. US stocks have hit new lows, and it seems that markets have now schooled us that we need to take our wins off the table when we can amid Trump's tariff storms. Welcome to the Daily. My name's Jessica Amir. I'm a market strategist here with Mumu. Thanks for your company this Friday, March the 7th. Well, investors are witnessing Trump's antics causing mass uncertainty. One day tariffs are on and the next day they're paused. Now, this is exactly what's happened in the last 24 hours, and the gains made in the prior session in the Nasdaq-100 and the S&P 500 have not only been erased, but we've seen both of the key indices hit brand new lows. The Nasdaq-100 is now officially in a correction. Let's have a look at that. We're just showing a chart here showing that the Nasdaq-100 is now down 10% from its high. That basically means it's in an official correction. Also, please note that it's trading under its 200-day moving average for the first time since the carry trade meltdown of July 2024. So investors really don't like the level of uncertainty under Trump. All it is brought in trade wars. The volatility index, which tracks market fear, is back at 25.25. That's its highest level since December, suggesting fear is gripping markets. Also, note investors are moving out of Tesla and into healthcare stocks. The lesson here, again, trim your winners under Trump's new administration. Perhaps that's the lesson. We're just showing a chart here that demonstrates that. So I guess if you can take away one thing from Donald Trump's first 46 days as US president, it would be exactly that. Trim your wins when you're profitable and position for downside. And this example of the chart in front of us demonstrates that. After Trump was elected, we can see that Tesla shares rose 77% to 275, or rather from 275.65 up to $488. That was a record all-time high on December 18. And in that time, they gained $574 billion in value. Great stuff. But since then, Tesla shares have dived 46%. They've fallen down to $261.03. And they've erased $660 billion in market value. That's more than the amount gained on the way up. While Tesla has been falling, we can see the humble healthcare giant on our screen. US pharmaceutical giant, by the way, CVS, their shares have risen in that time about 50% to $65.30. Now, this, ladies and gentlemen, is just one example that shows us that money is moving out of high-growth tech stocks and into defensive healthcare companies. Now, healthcare companies historically power through and remain profitable, regardless of tariffs or slowing economic growth. So that's something for you to consider. But it's not all doom and gloom in healthcare stocks or high-growth stocks for that matter. New high-growth stocks are taking over, and perhaps they're in commodities. In the S&P 500, stocks like Archer Daniels, Mosaic, Deere, they continue to move higher. As we highlighted yesterday, it's probably because the US dollar is continuing to fall. Now, on the screen, we're showing the Nasdaq-100 stocks and their post-market moves. We can see Broadcom shares are markedly higher in after-hours trading. They were up 16% at one point. They're now up about 15%, as we're showing on the screen in after-hours trade. Why is that? Good question, I'll tell you. Broadcom has reported stronger than expected AI sales, with their semiconductor division's revenue rising 11% to $8.2 billion. Software sales also surged to $6.7 billion. But wait, there's more. And good news. That's why their shares are up after hours. They see sales in the current quarter continuing to surge. So the current quarter ends on May 5, by the way. But they see sales surging to $14.9 billion. So it'll be interesting to see if these gains can be maintained when normal US trading kicks off. We can also see strategy shares. They are continuing to move up. And that's, of course, because the White House holds its first ever cryptocurrency summit that kicks off today in the US. What about Australia? Well, Australia's market is facing downside too. Yesterday, it fell under its 200-day moving average for the first time since September 2023. Australia's market is facing pressure. It's already down 6% from its February record all-time high. And the fact that it is under its 200-day moving average for the first time since 2023, it's a bearish signal. The last time the market fell under this level in Australia, the market then continued to fall, losing about 7% until the market rebounded. So I'm just saying that's what you might expect now. So why did the market fall under its 200-day moving average back in 2023 and then fall 7%? Well, markets were factoring in China's economic growth slowdown and central banks being more hawkish, as in interest rates needing to stay put. Hello, it seems that Trump's tariff actions are causing this exact same playbook that happened in 2023 to be played out again. So what I'm saying is duck for cover. Perhaps expect more down weeks ahead, not just days, but weeks. So consider looking at healthcare stocks to keep your heartbeat going. I'm also not sure about the idea of buying the dip into tech just yet, but let's reconvene next week after we've got US employment data out and after we get Australia's business confidence data. That's going to be released next week as well. For more information on the stocks that we've covered today, head to Moomoo's platform. Also consider how you can protect your portfolio in market down days. We'll put a link on Moomoo's platform where you can find this article on our website. From all of us here at Moomoo, we're wishing you a safe and happy weekend. Stay tuned to our weekly special edition. We'll be covering the EV stocks and maybe if this is a buying opportunity, given Tesla's stock has hit new lows. Bye for now.